Right, and let's get straight to the next corporate on the show. L&T Technology Services reported a good set of numbers, with constant currency growth coming in line with street estimates, although the company has revised their FY24 growth guidance, cutting it to around 17.5% to around 18.5% from 20% earlier. Reema caught up with Amit, Chadha, the MD and CEO of the company, and began by asking him about the quarter gone by and their rationale for trimming the guidance. Let's hear him out.
3.2% constant currency, 7 deals, new deals signed, out of which 6 of them are actually near $20 million. Not just that, in fact, in the first 2 weeks in October, we have signed 3 additional deals, one of them more than 10 million in cybersecurity, leveraging the SWC capabilities, and 2 of them more than $20 million, again, all global customers. So we do see deal making happening. We're very pleased with what we've been able to close. Having said that, there is a macro environment that's out there. There is a caution, if I may. People are being careful, and we have taken all that into account as we have reset expectations to come in between 17.5 to 18.5. I should, however, tell you that we will continue to work and see what we can do towards the upper end or more if possible, and come back and update in January again.
So you're trying to focus on achieving the upper end of the guidance. If not, it'll beat it.
Yes, please.
Okay. What about the margin performance? Your margin performance, even after absorbing the wage hikes, you've managed to clock in margins of over 17%. Could you give us the margin breakup? And your earlier guidance was to achieve 17% margins by Q4 of FY24. You've already done it in Q2. What could the revised guidance look like?
So margins for us, if you remember, prior to coming together with Smart World, we were at 18.5 plus percent in EBIT. And with Smart World, we've achieved 17.2 last quarter, 17.1 this quarter. I do have confidence we will stay in the 17% range for now. Of course, our ambition is to get up to above 18% again. What you realize is that on one side, we've got wage hikes, but on the other side, we have got pyramids that we can continue to fine-tune. There are freshers that we continue to hire, train, and deploy. In addition to that, we continue to automate some of the work that we're doing. So all those are positives for us, if I may. Finally, if you look at it, is the kind of work that we do. We are continuing to improve the kind of work that we're doing, more high-tech, that takes us away from a commodity business, puts us in a more specialized niche that allows us to be a premium engineering and technology provider for our customers.
You did say the United Workers strike in the United States impacted revenues in Q2. There was a loss in revenues on account of that. Could you quantify that? And what have you baked in terms of a loss of revenues on the back of this UWS strike, the delay in ramp-ups in the second half of the year?
So we had a very slight change because of the strikes to the extent of less than 50 bips in growth. But we did have that, and we have factored that into quarter 3. We do, we wish all the best to all the sides, but we think that we're just looking at it as an extended furlough season, if I may, in some of the projects that we execute, and we are trying to get beyond it now with various other wins that we've had.
Q3 will be seasonally soft for you, right? And you're expecting growth to bounce back in Q4. What could Q4 look like?
I would say Q4 will look like similar or slightly better than Q2.
Got that. North America growth was just 0.7% on a quarter-on-quarter basis. Can you tell us how corporate client behavior is currently?
Sure. So if I was to quantify the US, actually some of the US growth shows up in our India numbers because those are Indian purchase orders that we get from American clients. That's the way to look at it. But clearly, US is in that 0.61% range. And we are seeing growth avenues and opportunities in transportation, which we grew at about 4%, in plant engineering, which actually did very well and bounced back at 4% for us. And then somewhat in industrial products and medical. High-tech continues to be a challenge. We've had issues in Semcon and hyperscalers, consumer electronics. But I do believe that January onwards, those clouds should dissipate, given the new Semcon chips that are coming out. So broadly, I do believe that the US should do better Q4 onwards.
You spoke about very strong deal wins. Now, the conundrum is that why is it not translating into revenue growth for the entire industry per se? Can you tell us how your pipeline is? How does it compare with what it was 3 months ago or 6 months ago? And what has changed in the deal pipeline for you?
Sure. So one, if I look at the deal pipeline, there's a lot more 50 million, 25 million deals. There are some 100 million plus deals that we've got. We didn't have this a year ago. It's even improved in the last 3 months. It's there. So our deal pipeline is bigger. It's just that taking a little longer decision cycles, and now we are adjusting and getting used to it. So we are putting out multiple proposals to see which ones will close first. Also, the deal tenures are slightly increased. So where a deal tenure was, say, about 2.7 years in duration or 3 years in duration, they all extended now to 3.25 or 3.5 years in duration. So there is a little bit of expansion there that you see there. Overall, ER&D is supposed to grow. I mean, if you look at the latest reports coming out, ER&D is supposed to have a CAGR of about 8 to 12% in the next few years, actually reaching up to going from the $280 billion currently to $750 billion by 2030. ER&D in India is supposed to go from $45 billion to about $170 billion by 2030. So there is opportunity. There is there could be a very near short term, shall I say, seasonality in Q3, but we do expect stuff to continue to roll on and roll up. In fact, there's about 2,000 freshers that we are getting on board this year. More than 1,000 have already been onboarded. Remaining will be onboarded in the next 2 quarters. And we are starting to firm up numbers for recruitment for next year as well. So we continue to go about our operations.
Any deals which have gotten cancelled?
We haven't had any deal cancellations.
So just elongated decision-making cycles and some delay in ramp-ups?
Yes, please.
Okay. Tech budgets for your ER&D, tech budgets for your clients, do you think they will be growing in FY24? Will they be on time?
So interesting you asked that question, because the same report that I was referring to actually talks about, and this was done in October, sample size of about 300 executives across ER&D, and the results were that at least 70% feel that their budgets will be the same or expand, while there was about 30% of the respondents said that they could either see flat or slightly lower budgets for next year. So I would say that this is still in play. I would come back and check sometime in December, January, and as to how things turn out and turn up.
Okay, that's L&T Tech Services down almost about 3.5%. The street definitely not happy with the kind of revenue cut that they've seen in their guidance, or they've delivered in their guidance.